Yeah, so the last financial year has clearly been one of the more interesting ones in my career, obviously punctuated by good equity markets up until the first quarter of 2020, and then the COVID crisis hit. And the COVID crisis is something that a lot of us haven't had to deal with, but interestingly, from our point of view, probably just accelerated the views that we were having prior to the crisis, and I'm sure we'll talk a bit more about that today. But in the end, the fund did achieve nearly a 24% return for the year, which was one of the better years for the fund, after all fees and expenses. And importantly, nearly a third of those returns, or just a little bit more than a third of those returns, have come from our ability to short sell or our ability to hedge the portfolio through these difficult periods. And so that definitely did add to the returns on top of what are some of our core underlying views. Yeah, so look, when we think about COVID, it's important to be a little bit humble here because this is really unprecedented stuff in my lifetime, and I think most people watching this video. So we have to be a little bit humble about, we don't actually really know what the long-term effects of the COVID crisis will be. And so I think, and there's a lot of potential things that we haven't thought of that could come through because of the COVID crisis. But at this point in time, what we can say is that ability to be nimble that we showed through the first part of 2020, we still have that ability today. We still have the same disciplines around that ability today. And I wouldn't be surprised if we had to use it again in the months and years ahead at some point. But shifting to the long-term effects of COVID, I think the one thing that's become relatively clear to us is that social distancing is going to be here for us for a while. And if we look at social distancing, what it's causing is an acceleration in a number of the digital businesses we've been looking at for a long time. So if you just simply looked at the shift from cash to card, or the cash digital payments from cash, you can see an acceleration in digital payments here. PayPal's a company we look at. It's basically doubled its net actives in the months post-COVID. If we look at e-commerce has taken 20 years to get from 0% penetration of retail sales to 18% in the US. Yet in the first 6 months of 2020, it's gone to 25%. And so when we look at these companies, we're seeing a lot of their numbers being pulled forward. We're seeing a lot of earnings that we thought, or net actives that we thought would be 5 years from now, are actually now happening in 2020 and 2021. So it does make sense to us that their share prices have gone to new all-time highs. That makes sense to us. On top of that, we'd go on to say that the longer this crisis goes on, or the longer social distancing is with us, then the more embedded values that's going to be pulled forward here. And we think that that's something that's going to become apparent in the results. And while sure these companies will get ahead of themselves over the journey, inevitably it's very clear to us who are the big winners here. And what's also very clear to us is there's not very many of them. And so we expect them to continue to do well in the months ahead. So yes, obviously when we think about growth versus value, and look, this is very topical now because growth stocks are doing well, and we just explained some of the reasons why. But I think it's important to recognize that this has actually been happening for quite some time. And a lot of the trends we're seeing here have been happening for a long time. They're just accelerating in a post-COVID world. Now, the standard accusation as to why growth investing is doing well is that interest rates have fallen from, say, 20% to 1%. And in a post-COVID world, interest rates have gone lower, so growth stocks are going higher. And I think that is definitely part of what's going on, but I think it sort of also misses the point. Because from our point of view, Jeff Bezos set up a bookstore in his garage 20 years ago, and it's now worth $1.6 trillion. And that only happened because interest rates went from 20% to 1%. Or, Reed Hastings sets up a DVD store, DVD delivery service in California and turns it into Netflix. And that only happened because interest rates went to 20% to 1%. Or even here in Australia, Mike Cameron Brooks and his partner set up Put Software Online at the University of New South Wales and turned into Atlassian, which is roughly $50 billion. No, so it's pretty clear that there's actually something else going on here apart from interest rates falling. And the thing that's going on is clearly the acceleration in compute power. Like every generation before us, we are living through a revolution. Others have been through the transport revolution, the oil and gas revolution, the rail revolution, the retail revolution. We are living through the digital revolution. This digital revolution is being driven by Moore's law. And when we talk about Moore's law, we talk about computers becoming more powerful. And as they become more powerful, they grow their compute power exponentially. So put simply, in 1971, Intel's first semiconductor chip had 2,000 transistors on it. But every 2 years, it doubled the transistors and half the price. And now, here in 2020, Jensen Huang's new transistor at NVIDIA has 54 billion transistors on it. Computers are getting faster. Now, most people who are watching this video will see this all around them just purely by looking at the speed of the internet or what the internet's done in the last 20 years. You've gone from a point where it used to be able to send an email, to then being able to do search, to then being able to be on your telephone, to then being able to stream movies. And then now, even in this crisis, we're seeing how software is so important in our lives, and internet-enabled software, be it video conferencing from Zoom, etc. And so ultimately, as computers get faster, disruption accelerates, creating more and more of these wonderful winners. And these companies, disruption accelerates, and so for the people who are looking for mean reversion, this continues to confound them. If we extend this conversation on and we look at just what's happened in the last 10 years, and we look at the big platform companies that have won here, it's reasonably obvious to us that they are exploiting this relationship. They are spending heavily on R&D to effectively grow what their business can do digitally and in order to grow their sales. And they're being rewarded for it from their shareholders. And what's interesting against this is these so-called value companies that aren't spending on their business and doing so-called shareholder-friendly actions are actually not being rewarded by shareholders because ultimately they don't have sales growth. And I think if you follow this equation through and you look through it, what's becoming very, very clear to us is over the last 10 years, if we look at the companies that actually went up 10 times in value from 2007 to 2020, all of them have this sales growth characteristics. All of them have this ability to grow sales at more than 10%. And so I think the market is quite correctly rewarding companies for investing in their business and being able to grow their business because they are going to be the few winners. This is a game of very few winners and lots of losers. It gets worse in a digital world. And so as we look ahead, we just think it's inconceivable that you should be able to look at short-term multiples to drive long-term performance. It doesn't actually make sense. And so from our point of view, it's not really a growth versus value argument. It's quite simply as you have looked at next year's multiple and decided a company is expensive. And we don't see it that way. We think it's cheap because we're looking at what happens over the next 10 years. That's what's worked well for us for a period of time. We know why it's working well for us. And we think in a post-COVID world, it's going to become more important. And so from that point of view, whether you choose us as a growth investor or somebody else, we don't really mind, but you're going to need a growth investor if you're going to deal with the next 10 years ahead. We spend a lot of time talking about technology here, and obviously we want to push forward that expression of increasing compute power, but it actually applies to other industries. And so from that point of view, the other areas that the fund really likes are healthcare. Healthcare has a number of things going for it at the moment. One is that innovation allows them to drive price and new products and extend lifetimes for consumers and extend outcomes for their consumers. On top of that, the COVID crisis means that if you're a diagnostics company or you're a vaccine production company, you are the solution to this problem. And we do obviously all hope that this problem gets solved over time, but it's going to cost a lot of money. And so from that point of view, we'd talk about companies like Thermo Fisher or Danaher, where we see strong structural tailwinds for these companies in the years ahead, from COVID, but also from non-COVID biological drugs. The other area that we've liked for a long time now, and we do think will continue in a post-COVID world, would be climate change. It's become clear to us that obviously a lot of government stimulus is going to be required to get the economy going. In Europe, at least so far, this seems to be really focused on renewable energy. And we do think the transition to a fossil-free world probably accelerates from here. And there are a number of companies in the fund focused on renewable energy. And the key thing about this carbon shift is that unlike the technology shift I was just talking about before, it's going to take a lot longer. And we're really just at the start. So this is something that the fund can spend a lot of time on over the next decade. Yeah, so to sum it up, I mean, I think from our point of view, obviously it's a very difficult period and we're working hard to try and work out how COVID will evolve over the next 12 to 18 months. But what's abundantly clear to us is there are a number of areas that are net better off in a post-COVID world. These companies will be better off. How much they're better off, it remains to be seen, but they are definitely better off. And so how we've positioned the fund is to really focus on these areas. We've really found these areas of interest where we see acceleration. That acceleration will ultimately equal accelerated earnings for the companies in these areas. And our view is if their earnings from these companies continue to grow or accelerate, then their share prices can grow also. And that is our strategy for really navigating our way through this crisis. It's worked well to date, and we don't really see any impediments onto demand to suggest it won't work well in the future. Yes, valuation arguments will get difficult and may get ahead of themselves over time, But ultimately, the trend is now, I think, set. And in a post-COVID world, this is where we think the fund is best positioned for the months and years ahead.